Hello, everyone. Welcome to the ABFER webinar on capital market development, China and Asia. Today, we're really excited about the paper and the discussions. The author, the presenter is Professor Kai Li, Assistant Dean and Professor of HSBC Business School in Peking University. And he's going to present the paper Finance, Leases, and Capital Allocation in China. And our discussion is Professor Hengjie, Department Chair, Department of Finance, Wisconsin School of Business, U of Wisconsin-Madison. Without further ado, let me pass the forum to Professor Kai Li. Please, 25 minutes, yours.
Thank you, Bernie, for your introduction. Can you see my screen?
You have to double-click to enter full screen mode. Yeah, I see it now. Okay. Motivation, slide 2, slide 1. Yes, please proceed. I am not hearing any voice here. Do you guys?
Okay, so how about now?
Yes.
Okay, thank you, Bernie, for your introduction. I have been the consumer for this prestigious ABFER webinar series for a long time. I'm very happy that today I have this opportunity to contribute by presenting my ongoing work in terms of understanding the importance of finance lease market and its relationship with the capital allocation efficiency, in particular in China. This is joint work with Yuan, who is a PhD student at the University of Toronto, who is also in the webinar room. Now let me motivate the study. So we have seen explosive growth in China's leasing industry since 2007. Now it has become the world's second largest and accounts for 20% of the global leasing market. However, the moment when we zoom in to look at how does the market look like and compare it with developed countries' leasing market, for instance, US, we find a stark compositional contrast. For instance, US is predominantly dominated by the operating lease, which accounts for about 90% as compared with finance lease. But China, the composition is exactly opposite. So China's leasing market actually is dominated by the finance lease, which is more than 90%. I'm going to be clear about the distinction between these two forms of lease later. But in any case, this is kind of a very strong motivation for me to look at the importance of the finance lease market. So it is exactly because the finance lease is not that important in US in terms of its magnitude. Therefore, finance lease actually remains understudied in macrofinance in the mainstream studies. In the corporate finance view, it has always been considered to be equivalent to secure lending, and therefore there is no separate theoretical and empirical attention to this market. So let me bring you the nutshell summary of the key findings of this paper. Basically, this paper identifies that in the context of China, finance lease is playing a very unique role in enhancing the capital allocation efficiency. In particular, in the context of China's dual economy with SOE and the POE. And this finance lease becomes a very important market-oriented mechanism circumventing the SOE and the POE banking sector frictions. In particular, we provide some empirical evidence and also followed by theory to show that entities with privileged access to the cheaper financing, for instance, SOEs and also state-owned banks, they channel their funds to constrain firms with higher growth potential, mainly POEs, and using this kind of way to promote the capital allocative efficiency between SOE and the POE and circumventing the SOE and the POE banking sector frictions. And such role actually is enabled by the repossession advantage of finance lease, which is quite different from US. And this study also make a general contribution to the leasing literature. As I mentioned, because finance lease has always been considered to be equivalent to secure lending in the mainstream study. But this paper says that actually finance lease has its unique and special role, in particular in the countries, emerging countries with larger frictions in the traditional banking sector. Now let me give you the introduction about finance lease, and also as a byproduct, also compared with operating lease to provide you the background information. So instead of giving you the detailed concept and definition, let me give you two examples. For instance, one example for the operating lease, for instance, dealers help you to finance a car purchase and you repay by installments. So essentially, this economically is equivalent to the secure lending. While in contrast, if you do it through the operating lease, it's like you directly rent a car for the short-term usage. And these two, the key distinction between these two is that the ownership rights belongs to whom. So if we use this flow chart to denote it, so for the finance lease, which is in the upper panel, it says that during the lease term, the ownership has been with the lessor or the lender, while after the lease term contract ends, ownership will go to the borrower. So this is corresponding to the case where you purchase the car through installments. While for the operating lease, towards the end of the lease contract, actually the ownership has to be returned back to the lender. So this is a key difference. So in the following of my presentation, I'm going to arrange my talk in the following several parts. First, I'm going to use some example finance lease contract to illustrate a very important feature of the contract in China, which is called repossession advantage. And then I'm going to provide you macro and micro evidence. How does the finance lease market work, and why, and what motivates us to think about its role in terms of facilitating the capital reallocation efficiency. And then lastly, it will follow by general equilibrium model to illustrate all these stylized facts for the finance lease market, and also provide intuition about the capital reallocation efficiency role of this important market. So now
a quick clarification, please. Kai?
Yes, please.
Clarification question. In between the two forms of lease, there's also a component about maintenance.
Yes.
How is that differentiated between the two forms?
I think for the finance lease, because eventually the equipment will goes to the borrowers or lessee, right? Therefore, lessee is going to be in charge of the maintenance. But for the operating lease, because the ownership has always been belonging to the lessor, right? Therefore, in most of the case, lessor will in charge of the maintenance. It means that actually in these two forms of the lease, exactly because of the differences in the ownership, two different parties actually are going to in charge of the asset associated risk. So this is a key difference between these two forms of lease. Am I clear, Bernie? Okay.
Thank you.
So now let me show you this contract. Okay, so please look at the right-hand side here. So this is a finance lease contract between Yuan Linzhi Limited Corporation with a leasing company which is called Zhonghang, and the asset type is the paper making machines. And here we have the contract details. Okay, so the very important contract details related to the repossession advantage is highlighted in red. So it says that during the lease term, the ownership of the leased property always belongs to the leasing company. Only after the lease expires, then and after all the installments has been successfully paid, then Yuan Linzhi, the borrower, will need to pay 100 yuan in order to transfer the ownership of the leased property back. So this is very important. It implies that actually in China, lessor enjoys a significant amount of repossession advantage, which is different from US. So let me draw the contrast. So basically, according to what the example contract that we showed, in China, actually, the legal ownership of the asset remains with the lessor. And if in case of the default of the borrower, lessors can actually possess the asset directly by passing the bankruptcy procedure. So this is ensured by current Chinese contract law. However, in US, actually, finance lease actually are often recategorized as secured loans in bankruptcy. And the asset will become part of the bankruptcy estate in case of the default and therefore subject to the automatic stay. So therefore, as a summary, actually, in US, finance lease is considered to be equivalent to secured lending. But in China, actually, finance lease is equivalent to finance lease plus additional repossession advantage. And this additional repossession advantage, as I show later through the micro evidence, is going to be very important in terms of its facilitating of the capital reallocation efficiency in China. So which I'm going to talk about later. Okay, so now let me provide some macro evidence. So this figure shows the outstanding finance lease amount over time. So as you can see that actually at the peak time of 2018, the outstanding finance lease is amount to 6.7 trillion RMB. And it becomes a major shadow banking component comparable to interest loans, which is amount to 12.4 trillion RMB. And if we compare this size of 6.7 trillion, actually it amounts to 20% of the traditional bank loans devoted to the POE sector. So it shows that actually the outstanding finance lease actually has been becoming a very, very important supplement to the financing of the Chinese non-financial corporate sector. And in order to get some contract level information details to zoom in, so we manually collect the financial statement and also lease mandatory announcement for the public listed lessee companies as required by our regulatory authority. And of course, this is only like a very partial part of the lease contracts ever exist in the leasing market. So in total, we identified about 4,500 contracts, and the total amount of finance lease amount is about 800 billion. As you can see that this is just the tip of the iceberg, but I think that it is going to be a very important lens for us to examine and investigate what's going on for this market. And we imagine that the finance lease actually is going to be even more critical for funding the non-public POEs, which is not currently in our database. Okay, so now let me summarize 4 stylized facts from the micro evidence. First is about the market participants. So from the micro level data that we collected, we find that actually SOEs dominates as the lessors. For instance, it accounts about 80% of the contracts or 78% of the lease volume. While POE is going to be a very primary source of lessees or borrowers among the public listed firm. So I listed number here, and as I mentioned that if we were able to find the non-public lessee information, we expect that POE actually represents an even larger share among non-public lessees. Okay. So second stylized facts is what is the profile or what is a picture for the lessor look like. So I won't have time to go through all these detailed numbers, but let me summarize them in words. First, we find that actually these lessors, they typically have lower growth and fewer investment opportunities, but they have advantage of getting access to the cheaper and stable funding. And therefore, they provide lending service through the leasing channel in order to pocket the interest spread. And the average interest spread for SOE lessors is amount to 1.4% according to our calculation. Now, next stylized facts is about the profile of lessees. Okay, so what we find is that actually lessees are in opposite. They typically have higher investment and growth opportunities, but they have tighter debt capacities relative to their financing needs. and therefore they borrow additional borrowing capacity from the leasing market. And if you look at the POE lessees, on average, actually going through the leasing channel, help them to save their funding cost of 0.5% as compared with their otherwise bond issuing rate. Lastly, let's also look at the collateralizability patterns or the loan to valuation patterns for the traditional bank loan as well as the lease. So what we find is that indeed, POEs has a lower collateralizability than SOEs in the traditional banking sector. For instance, if we calculate the loan to valuation ratio among the financially constrained firms, what we find is that SOEs loan to valuation ratio is about 0.5, while the private POE sector only half of it. But if we look at the finance lease, actually finance lease, because of its repossession advantage, actually it demonstrates much higher collateralizability for both SOE and the POE firms. And what we find is that actually for both SOE and the POE firms, actually the average loan to valuation ratio from the leasing channel actually is almost similar to each other. It's amount to 0.6, which is larger than the loan to valuation ratio both for the SOE as well as POE on the traditional banking sector. So this implies that actually the repossession advantage enjoyed by the finance lease effectively can create two effects to motivate and facilitate the capital reallocation efficiency. First is a level effect, because this ADA, the loan to valuation ratio for leasing, is larger than the loan to valuation ratio for the traditional banking sector for both SOE and the POE. This means that actually this level effect is going to have help everyone to relax their financial constraint. Secondly, it's going to have a slope effect. Why? Because the ADAs, or the loan to valuation ratio in the leasing market, actually is equivalent, almost equivalent for the SOE and the POE sector. Therefore, it will help us to eliminate the asymmetry in the credit access of the SOE versus POE sector on the traditional banking sector. So this is going to create a slope effect. Okay, now let me give you the key narrative. How does the finance lease market work? Basically, lessors are those SOEs which has cheap funding but low investment opportunities, while lessees or borrowers are those firms with growth potential but suffer from the funding constraint, predominantly by the POE. And the lessors actually, they redeploy their excess capital to earn interest rate spread, while lessees, they can access to the critical growth funding unavailable through the traditional banking sector otherwise. And this mechanism actually is promised or enabled by the repossession advantage, and it creates a level effect by relax the financial constraint for all firms, as well as a slope effect by circumvent the asymmetry of the SOE and the POE's privilege into the traditional banking sector. And the total outcome is that the finance lease is going to facilitate the efficient capital allocation from the low growth SOE to the high growth firms, primarily POE. So this is the basic narrative of the finance lease role. So next, I'm going to use a general equilibrium model with two sectors, two dual track systems, namely SOE and the POE, and also features finance lease activities explicitly in order to capture the above stylized facts. In particular, what I would like to emphasize is that in my model, the lessor and the lessee itself is an endogenous decision of the firms, so that I can use this framework to illustrate how the model can capture the stylized facts that I introduced as above, as well as illustrate the intuition how the finance lease market is going to facilitate the capital reallocation efficiency, in particular in China, as represented by the dual track economy. Okay, so household is very standard. Now let me focus on the firm. So I assume that actually there are two sectors: SOE sector, which denoted as S, POE sector, which denoted as P. And within each sector, there is a continuum of firms with idiosyncratic productivity as represented by epsilon, which is drawn from a distribution. And this is the production function for each individual firm in sector J, which is linear in the sector level productivity ZJ, and the firm's idiosyncratic productivity epsilon, and also linear in the total amount of utilized capital used by this firm. And I use ZS and ZP to denote the sector level productivity for SOE versus POE sector separately. And in our model, actually, we only have two minimum but key differences between SOE and the POE motivated by the previous stylized facts. First, we assume that the sector level productivity POE is higher than that of the SOE. That's to say ZP is higher than ZS. And secondly, we model the SOE has a privilege in accessing the traditional bank loan market. So suppose this is the borrowing collateral constraint. BJ is bounded by theta fraction of the owned capital of the company, and the theta J is the collateralizability or loan to valuation ratio parameter. And in order to model the privilege of the SOE, we assume that theta S is larger than theta P. So these are the two important key differences between SOE and the POE. Now, let's further look at how do we model the finance lease market. So finance lease, as I said, economically, it functions like a collateral constraint. So LJ is denoting the lease loan, while eta J is denoting the collateralizability of the leasing market. KLJ is denoting the amount of the leased capital. And the repossession advantage tells us that lease loan enjoys higher collateralizability, which is consistent with the previous empirical evidence. Because in China, finance lease is equivalent to secure lending plus additional repossession advantage. And therefore, we make the assumption that for the collateralizability of the leasing market, eta S is equal to eta P. But both of them is larger than the collateralizability for both the state-owned sector as well as the POE sector. And this assumption actually is consistent with the previous stylized facts, number 4, and it also creates two effects. One is a level effect, and the other one is a slope effect, which has been illustrated before. Okay, so now let's look at the firm's optimization problem. Basically, firm is going to make two decisions. First, they are going to decide whether they are going to produce or not based on their productivity level. And if they choose to produce, they have to further decide whether they would like to use owned capital to produce or use the leased capital from the finance lease activity service to produce. And if they decide not to produce, then they are going to decide whether they would like to lend through the traditional bank loan market, or they would like to lend through the finance lease market serving as the source. And this is the optimization problem for firm. So the profit of the firm is consisting of the production output minus the depreciated resale value of all the capitals minus the debt repayment for the traditional bank loan as well as the debt repayment for the lease loans. Okay, and subject to a bunch of constraints. So first constraint is the flow of fund constraint, which is easy. So the purchase of the capital has to be financed either by the internal networks or financed by the borrowing from the bank or from the source. And the second constraint is the traditional bank loan constraint. So please remember that we allow firms to also lend out. Therefore, firms can either borrow up to the limit as a theta fraction of the KO, but the firm can also serve as a lender to lend out the net worth HJ. And the last constraint is a lease loan constraint. Basically, on the one hand, the firm can borrow the upper limit of the lease loan as the collateralizability of ADA, but at the same time, this firm can also choose to serve as the lessor to lend out its own net worth as well as its borrowing capacity that they can borrow from the bank. So this is the basic idea. So allowing for these two kind of constraints, we can see that in this economy, any firms can optimally choose whether they would like to become a lessor or they would like to become a producer, which produce on the market. And let me give you a few properties, right? For instance, the collateral one says that RL should be always larger than R. Otherwise, there will be no incentive for a firm to serve as a lessor. And the collateral 2 says that, okay, so the within sector firm decisions is going to be look like that. So for instance, if we look at this figure about the threshold for firms to become lessor or to become producers, the upper panel is for the POE, while the lower panel is for the SOE. Basically, less productive firm will choose to become lessor to lend out their money. The intermediate productivity firms, they are going to choose to borrow from the bank only, while the most productive firms are going to choose to borrow from the lessor in order to have a higher debt capacity. And also, if we compare the upper panel with the lower panel, you can see that actually the threshold of become lessor for SOE is to the right-hand side of the threshold for the POE lessor. So this is consistent with empirical evidence that SOE are more likely to become lessor as compared with POE because of lower sector level productivity. And if we look at the two thresholds regarding to whether POE or SOE become lessee, you can see that the threshold for SOE to become lessee is to the right-hand side of the threshold for the POE. So this implies that actually POE is more productive, POE is more likely to become lessee, which is also consistent with the data. So with all these endogenous lessor and lessee decisions, now I can give you a summary of the model implications, how the facilitation of the capital reallocation efficiency is going to be achieved. For the SOE sector, TAP gain is from the fact that the finance lease sector industry allows low productive firm to become lessors and allow high productive firm to access additional leverage. For the POE sector, finance lease industries allows high productive firm to overcome the financial constraint. And overall, the net capital reallocation is going to reallocate from SOE to the POEs so that it enhances the cross-sector capital allocation efficiency. So this is the basic intuition about the facilitating of the capital reallocation efficiency. We are going to do a quantitative study, but I won't have time to talk about it. Now, let me conclude by briefly mention a perspective about the US and the China comparison, right? So we have answered the question why finance lease is so dominant in China from the previous studies because of the China's dual track system, and the China finance lease industries will help to circumvent the SOE and the POE asymmetry in terms of the banking sector access. Then the question is why it is so limited for the operating lease for China. So this is related to Bernie's question. Because if for the operating lease, lessor companies has to bear the asset associated risk. And in China, basically, the cost of for lessor companies to bear the asset associated risk is too high because we are in lack of a very much developed secondary market, capital market, so that lessors actually is going to be very difficult to redeploy their used capital. So this is our suggestive evidence, but it's suggestive reasons, but we are going to continue to work on it through a companion paper. So now let me summarize. So basically, this paper emphasizes a unique role of the finance lease market by emphasizing that it is a market-based mechanism addressing the SOE, POE, banking sector frictions. And there is a general theoretical contribution advancing the leasing literature, showing that actually the finance lease, which was underestimated and understudied in the developed countries, actually play a very important role in developing countries where the banking sector friction is higher. And it also has important policy implications in terms of the shadow banking regulations. So let me stop here. Thank you very much.
Thank you. Hengjie, please help us to understand the paper. Thank you, Guy.
Can you see my slides okay?
Yes.
Yes.
Okay. All right. Thank you, Bernard, for inviting me. And thanks to Kai for writing a non-trivial paper. Took me a while to understand. So let me just give a brief summary of the paper. the paper documented some facts about financial leasing in China by using contract level data. So the main facts are the SOEs are, account for most of the lessors, and basically state-owned, SOEs lend to POEs, right? POEs represent the majority of lessee contracts. POEs are in general more productive and grow faster than lessors. And in addition, the loan to valuation ratio of these contracts are informative about fundamental parameter values. So this is one aspect of the paper that I really like, which is using evidence, micro level evidence, to speak to some important parameters of a macro model. The paper presented general equilibrium model with dual track system, and these dual track system means the presence of both SOE and POE, sorry. There are bank loans, leasing contract, they are subject to collateral constraints, and there's heterogeneity in contract enforceability. Eta is a parameter for leasing contracts, and theta is a parameter for bank loans. So I'm gonna, get to it in a second. The models are calibrated to match macro evidence to quantify the impact of financial lease. There's really three parts of the paper. The first part of the paper is micro level evidence, contract level evidence for financial leasing. The second part is a qualitative model that shows this particular mechanism, the heterogeneity in the contract enforceability of leasing contract and bank loans explains the facts documented in the first part of the paper. The last part of the paper is a quantitative model that uses the micro level evidence to inform the parameter choices of the model and to quantify the capital misallocation and how financial leasing improves the efficiency of capital allocation in the Chinese economy. So like Kai didn't really have time to talk about part 3. Like each one of these parts can really, in my opinion, be a paper because there's just a lot of details that goes into it. So I'm gonna talk mostly about the like a qualitative model, but there's a lot of interesting things in the quantitative model I didn't have time to cover, and I wouldn't be able to get to it either. But it's a very impressive quantitative exercise. So I'm just gonna have spend a few minutes to kind of introduce the key intuition of the model, and I'm gonna make some comments and questions. So the main idea of the leasing contract or, like contract enforceability, and I think like earliest coming from, Kehoe-Levin. So what does Kehoe-Levin do? Like think about limited commitment, right? So and the example I like to give is, suppose Kai has endowment 0, 10, 0, 10, 0, 10. I have endowment 10, 0, 10, 0, 10, 0. Both of us are risk averse. So the optimal risk sharing contract is gonna be Kai 5. I consume 5. I consume 5. Kai consume 5. Full risk sharing, right? One day, Kai wakes up and he sees he has endowment of 10. I have endowment of 0. He's gonna be like, okay, according to the optimal contract, I need to give Hengjie 5. But why don't I just consume all 10 apples, right? So Arrow-Debreu contract, which is a full risk sharing contract, says any contract can be implemented. But whenever Kai has incentive problems, he's gonna think, okay, maybe I should not be, giving 5 apples to Hengjie to implement the full risk sharing contract. Maybe I should just take all 10 apples away, right? Well, whether he's gonna do that, he's gonna default on the contract depends on what I can punish him in the event of default. For example, if both of us are risk averse, if once he default, I'm gonna say I will never enter into another risk sharing contract with Kai. If he's really, really risk averse, he's gonna say, hey, tomorrow if I get 0, I'm gonna be miserable. So that punishment is gonna be able to reinforce good outcome in the contract. If, for example, Kai is very popular, Kai can go to some other people and say to sign a different risk sharing contract. If the punishment is not very severe, he would have a lot of incentive to deviate, to default on today's contract. So Kiyotaki, Moore, and Pini Vishwanathan kind of putting that basic intuition of commitment and contract enforceability into a production economy. This is a very simple way to illustrate that. Suppose Kai borrowed K units of capital and on a $B loan, right? If he honored the contract, he has the capital, he need to pay back loan, that's his payoff. If he doesn't honor the contract, suppose he can get away not with full amount of capital, but with a fraction of capital. So he's going to lose theta fractional capital. Incentive compatibility says the payoff for paying back would have to be higher than the payoff of default on the contract. Anticipating Kai's incentive problem, I'm going to say I will never lend Kai more than theta K, because once B is higher than theta K, he has a higher incentive to default. So in order to think about, so that this is a collateral constraint. It's really incentive compatibility constraint from the borrower's perspective. What Kai bring into this picture is that he's going to think about the differences between the collateralizability or incentive compatibility for different type of loan contracts. Bank loan has a smaller theta. Leasing loan has a bigger theta. Why? Because especially for financing lease, in the event of default, the lessee will not be able to get away with any amount of capital. So the punishment is more severe. Because eta is higher than theta, the punishment is more severe. You can implement higher borrowing capacity for firms using financial leasing contract. Okay, so Kai think a lot about like, you know, which firm borrow, which firm lend, which firm lease, which firm are lessees. I want to think a little bit about from general equilibrium perspective, because this economy is an economy with SOE who have low productivity, POE that has high productivity. The production function Kai wrote down is constant return to scale. Therefore, if I'm a social planner, I'm thinking I should allocate all of the capital into the hands of POE because they have higher productivity and production technology is constant return to scale. The question is, can this happen? If this can happen, we're achieving the most efficient productivity, efficient outcome. So, okay, so Kai, H cannot be net worth, W is net worth. So I want to think about, you know, incentive problems of productive firms. If I'm really productive, I'm going to borrow, I'm going to set B to be positive, but subject to this incentive collateral constraint, right? Theta is the amount of down payment I need to put down in order to borrow B. Because I'm really, really productive, I'm gonna exhaust all borrowing capacities. I'm gonna lease capital as well to as much as I can, but subject to this constraint. If I'm a firm that's not so productive, kind of medium productive in Kai setup, then I'm gonna exhaust all my borrowing capacity with bank loans. But I'm gonna lease out because I can make more money by leasing out to the more productive firms. When I lease out, this constraint basically says, okay, you can't lease more than what you have. What you have is your W plus your bank loan. Okay, so let's think about the POE's problem. So a POE basically product using constant return to scale technology. This is the total amount of capital that's equal to your net worth plus bank loan plus leasing contract. You need to pay back bank loan at raised interest rate R. You pay back leasing loan at potentially higher leasing interest rate. The POE can allocate W fraction of capital to borrow ownership capital. I'm just going to make a very simplifying assumption. In Kai's under Kai's parameter value, the POE has a lower borrowing capacity via bank loans. I'm just going to assume that POE has zero borrowing capacity. So theta POE is equal to 0. So in Kai's setup, theta POE is less than theta SOE. But this is simpler. Basically, if you're POE, forget about borrowing bank loans because you can't. The POE is going to allocate W minus the rest of the wealth net worth is going to be allocated for leasing capital. So total amount of leasing capital is the wealth you allocated to leasing capital plus the total amount of leasing. And the leasing is subject to the constraint that L has to be less than eta times KL. This is the total amount of capital constraint. Immediately, you're going to see that if ZH is higher than 1 plus, so because POE has to set B equal to 0, the only way they can borrow is using L. Immediately, if their productivity, so I should have ZP, is higher than leasing rate, then what POE is going to do, they're going to set K ownership capital to be 0, because you need to do that anyways, but you're going to maximize your borrowing capacity and to borrow as much as you can. So if you lease L amount of capital, this is your net worth. You're gonna set L so that the incentive compatibility constraint is binding. The maximum amount of capital that can lease is WP divided by 1 minus eta. What does SOE do in this economy? Well, SOE can borrow from the bank. They solve the same problem. They can produce. In the case when they produce, this is a total amount of capital they can put into production. They borrow a bank loan, they lease. They could potentially lease. Subject to the same borrowing constraint for ownership capital, leased capital, and this the total amount of capital has to be less than net worth plus borrowing bank loan and lease. But potentially they can also set L to be negative. If RL is really high, they rather lease out their capital instead of using capital for own production. So really the SOE is choosing a maximum between the two, which is if you borrow B, you can lease out all of your capital and you can borrow a bank loan. Or you can use W plus B for production and borrow a bank loan. Obviously, they're going to choose lease if 1 plus L, RL, is higher than ZS. If they're productive enough, they rather, if ZS is higher than 1 plus L, they rather produce them themselves. So here's what's going to happen in equilibrium, which is, okay, so this is what's going to happen for SOE. If they're not very productive, they're just going to lease out all their contract. And if the borrowing constraint, bank loan constraint is binding, they're gonna lever all the way up to 1 minus theta J, but they may or may not be binding. If they are productive enough, they're gonna produce. Again, they may lever all the way up to WS divided by 1 minus theta, but maybe they don't need to lever all the way up. If the leasing rate is the same as their productivity, then they're indifferent. They can choose any interior amount. So what's going to happen in general equilibrium? Well, I'm going to assume that WP is less than K. What does it mean? That means the POE sector. Remember, if you're a planner, you want to put all the capital into the hands of POE. I'm going to assume that the wealth of POE is not enough to absorb all of the total capital stock in this economy. So there's going to be three cases. Case one is that if POE lever all the way up to 1 minus eta, and SOE all lever up all the way to theta, they can all absorb all of the capital in this economy. What that means is that the POE in this economy, if they exhaust all their leasing capacity, they can absorb all the capital in this economy. Obviously, that's going to be the most efficient allocation. That would have to mean the POE's leasing constraint cannot bind, so that the POE can choose some amount of KL, some amount of KL. But because their leasing constraint doesn't bind, it has to be the case that ZP is equal to 1 plus RL. Otherwise, they're going to lease all the way to exhaust all their borrowing capacity. So the leasing rate is going to depend on the productivity of POE. This is a high lease interest rate economy. It's high leasing rate because the POE in this economy have so much wealth, they have a lot of demand for capital. SOE, on the other hand, their loan constraint cannot bind because they have more than enough capital networks to absorb all the capital. So the interest rate is going to be equal to our leasing rate. What happens in this economy is that SOE is going to borrow from the bank, but they're not going to use any of their capital for production because they reallocate all the capital to the hands of POE because that's the most efficient allocation. It's a first pass production. It's a first pass outcome, but it's not feasible without leasing because remember that if without leasing contract, without levering up, the POEs are not able to absorb all of the capital because they don't have enough net worth. So leasing, in this case, achieve a higher efficiency of capital allocation because POE owns all the capital in this economy. Case two is that the POE by themselves, they cannot absorb all of the capital. But POE and SOE together, they have more than enough net worth. If they all lever up, they can absorb all of the capital. What's going to happen in this case is that POE is going to exhaust all of the borrowing capacity. They're going to lever all the way up to lease capital. That also means that RL does not have to equal ZP. Even RL is less than ZP. POE want to lever up and borrow a lot more, want to lease a lot more capital. They cannot. The constraint is binding. So RL is not determined by ZP. They're going to determine by the first order conditions, the SOE. What does it mean? Remember, in this world, the social planner is going to say, I'm going to put as much capital as possible to the hands of POE, but there's going to be some capital left. The capital left would have to be used by SOE. So what happens is that SOE is going to use part of the capital production and part of the capital to lease out to POE. That have to mean that SOE need to be indifferent between leasing out or production. So the lease rate is going to determine by the marginal product capital for the less efficient SOE. This is a low leasing rate economy because POE doesn't have enough net worth to absorb all of the capital. This allocation is obviously not first best, but it would still be more efficient than the allocation without leasing contract because as the POE, the productive firms, levered up and use as much capital as possible to absorb all of the capital. But this is a case where the SOE is not gonna absorb all their borrowing capacities because SOE and POEs together have more than enough net worth to absorb all of the capital. It may be that both sectors are constrained. What it means is that even the SOE lever all the way up to exhaust their borrowing capacity on bank loans. Even the POE lever all the way up to exhaust their borrowing capacity on bank loans. They will not have enough net worth to absorb all of the capital. So SOEs will have to be indifferent between leasing out and production, but they can be, RL can be higher than R, and R has to be determined by the least productive guys, which I don't model. Kai has a lot of unproductive firms in his model. So I have a couple comments. I'll be quick because I'm running out of time. I really like the fact that this paper using micro evidence to discipline the trace of theta and R, theta and eta, calibrate the model to match micro evidence, and the paper first explained the facts which is SOEs are less productive than are lessors, and POEs are more productive, they are lessees. And there's, once you write down the model, that dynamic model can be used for counterfactuals and policy analysis. In particular, it can answer the following question, which is, if you implement some policy, the model is going to be able to account for the endogenous response to the leasing market. So I think it's a really, the quantitative part is a really convincing exercise. My comment number 2 is that there's a really interesting feature of the model is misallocation not only come from financial constraint, but also from policy distortions. If you think about models with misallocation, a lot of these more classical papers like Benmol, Michigan Shu, misallocation really come from heterogeneity in production. But in the case of China, as Kai illustrated, the different sectors has different access to bank loan contract. So policy itself introduced another distortion, and leasing contract is a way to get around these leasing distortions. So I think there's a really Kai didn't have time to talk about the quantitative part, but the quantitatively financial leasing accounts for roughly 3 to 4% of the capital misallocation. So in this paper, Kai does the exercise that kind of she and Clino and a lot of literature in capital misallocation literature do, which is quantify the amount of TFP or production efficiency loss that coming from capital misallocation. I thought the paper can be used for answering many other interesting questions too. For example, if you lose like 4%, I don't know, 4% of GDP is already high, but if you lose 4% of GDP every year, steady state, you're going to accumulate a lot less capital. It's going to affect the long-run growth rate of the economy. So the per period loss in GDP presumably is a lot less than if I think about dynamic model, the losses in economic growth. So I think those are, potentially even more important questions than the TFP loss itself. And I think this paper is definitely capable of answering all of those questions because there's a well-specified dynamic model allows Kai to take into account of how TFP losses coming from financial constraint would translate into steady-state economic growth. You can ask the following warfare questions. How much permanent consumption would the agent in this economy be willing to pay in order to exchange for the availability of financing leasing, like Lucas warfare questions, right? So those questions are potentially more interesting actually than the static TFP loss, which is a lot of this capital misallocation literature focus on. But I think the model allows Kai to answer all of those questions, which are potentially interesting as well. The related comment I have is Kai follow, in a quantitative part, follow the standard practice in macro calibration. We calibrate the model to steady state. We think about steady state TFP loss. But the other reason I thought thinking about growth is more interesting is that if I look at the the leasing, the number of outstanding leasing loans, it doesn't look like we have reached a steady state. Maybe in the last 4 or 5 years you can argue that, but apparently there's a lot of growth in this market. So I felt like answering the questions about how much of the growth of the financial leasing market contribute to the economic growth in China may potentially be even more interesting question than quantifying TFP loss. So I definitely run out of time. I think let me just conclude. I think it's a great example of a paper that connect micro evidence to macro models and to provide quantitative answers to important questions. I think the model has a lot more to offer. For example, economic growth, questions about economic growth and welfare, than Kai and co-author currently advertise. Thank you.
Bernie, you muted yourself.
Thank you, Hengjie. Thank you a lot. Thanks to both. I wonder if the other panelists have any questions before I turn to Kai to ask him to respond, maybe I'll ask a few questions. I mean, this is complicated, and I'm trying to understand what is really the biggest driver of the model. Would it be the case that I have some fixed asset and there are two groups of firms? Some are more capable to use the asset than other, and that create the leaser and leasee possibility. At the same time, they have different financial constraints. Is that the main driver of the question of the paper?
I think the main driver of the paper is that two things. The first thing is that in our dual track system, SOE companies actually they have privilege to get cheaper financing.
That's what I mean by some are
Yes.
more able to access
More able,
funding.
yes. This is consistent with
Right.
what you said.
Yeah,
And then
and then
secondly,
the other one is that
yes.
they are different capability in using the fixed
Yes,
assets.
exactly. The second is that
Right.
they can work through a market mechanism through this repossession advantage of
Right.
the leasing contract to further lend out their excess capital to those other firms who are more productive and have higher finance needs, but are limited by the access of the traditional bank loan sector.
So in this case, you know, this is the beginning drive of the model that lead to the various insightful results. I want to ask a few additional questions. The first one is that in the leasing company, literally, I just interpret the leasing industry, they mostly are based on fixed assets. Sorry, very, very long-term, large, like airplanes, ships, and so on, and cars. Then there's something that's really interesting, in my opinion, that when it gets to, I mean, in your model, you get to the point about when you go to bankrupt, when you cannot sustain the business, and then you have to go to bankrupt. And now, whether the leaser hold the ownership or not makes a difference, right?
Yes.
So the choice of the type of lease depends on, you know, the expectations on the likelihood of going bankrupt, and that drives a question on the liquidation, because all these long-term fixed assets are very illiquid. Leasers are very capable in reallocating these fixed assets. I have a plane, somehow the airlines fall apart, but the leasers, they know when this will happen, and they know when to reallocate the plane to to a better user. So there is one element here in this business that is about the unique capability in managing the liquidity of the assets.
Yeah, I agree with you, Bernie. Actually,
Yeah.
this is a very good insight. So basically, what you are saying is that on top of the repossession advantage enjoyed by lessor, actually lessor has additional capability of redeploying their returned asset in case of the bankruptcy.
Right.
This is also going to contribute to the importance and incentive for providing leasing service.
Right.
I completely agree with you.
And then this capability is developed over time, by the way, because of their specialization by backward induction. This capability is actually helping to reduce the leasing cost for the leasees.
Yes, exactly.
Right.
Yeah,
Right.
I think so currently actually in our theoretical framework, in order to highlight and exclusively isolate the effect of the repossession advantage, we didn't incorporate this. But I believe that if we incorporate this further, then I think it will create a reinforced effect for the importance of the finance lease.
There's a lot of further insight by going into this angle to get to the efficiency, the economic gains and loss argument here. And then one more thing is that the loan over collateral level for leasing is a lot low. Like I can lease without owning. So in other words, it's almost like I have a mortgage without any down payment, right? And but the loan to asset ratio is very high.
Yeah, so
Right.
you still need to put a certain fraction of the down payment as
But smaller
lessee.
down payment.
It's just that the amount of the down payment that you need to put if you borrow through the leasing channel is going to be lower than the required down payment if you
In the extreme case,
from
the down payment could be
bank.
zero. In the
Yes,
extreme
in the extreme case,
exactly.
for instance, if we
Right.
consider, for instance,
Right.
like the
At
extreme
the same
level
time,
of the repossession advantage, yes.
At the same time, this kind of arrangement is different than the traditional bank loans. And my understanding is that most of the leasing companies come from, number one, they are subsidiary of the current banks in the case of China. Number two, some of the the wealthy families are getting into long-term leasing as well. So when you say the SOEs not having the capability and become the leaser, how does that square well with empirical observation? Leasing companies,
Yeah.
most of them
So
are coming
this
from-
is actually a very good question. So if we divided the source, actually there are two types of lessors which I haven't had a chance to cover. One is called a bank affiliated lessor. So this is the type of lessor which is subsidiary of the parent bank, which is what according to what you said just now. And there is another important type which is called a non-bank affiliated lessor, which typically are set up by those SOEs or other entities with cheaper financing sources.
Right.
And what I would like to say is that actually in the data, 70% of the lessors are non-bank affiliated, while 30% of the lessor are bank affiliated, which means that actually non-bank affiliated lessor actually constitute a majority fraction of the finance lease providers.
I believe that this observation is valid. At the same time, the regulators are putting their hand onto this. They are raising a lot of new regulatory restrictions, as I understand it. It would be very worthwhile to go into that empirical, the contextual side to see what's the implication for sensible regulations.
Yeah, I think so.
I mean,
So
what you're saying
basically,
is that what
you are
you've
saying
done.
that, yeah.
What
Yes,
you've done
please.
is that what you've done is that many of the SOEs, or maybe just very rich people, they have money but no idea. They can buy the asset and then I can lend the asset to Hengjie and to you. I can
Yes.
lease them to you and so on. And now if the regulators come in and say don't do that, then what's the implication? So that's another angle of seeing the contribution of your paper.
Yes, exactly. Actually, I'm very glad that you asked that question. Actually, I have some policy implications which is exactly related to the shadow banking regulations.
Right.
Basically, if you look at the macro level evidence, you see that after 2018, actually there is a declining trend for the outstanding lease amount, right? So which is consistent with the shadow banking regulations conducted in China starting from 2015, 2016. But
I'm sorry that I'm sorry that I used so much airtime. Let me turn to the panelists to see if anyone, like Xiaoyan, I don't know whether do you have any comments, please?
Hi, no, I listened to this paper before. I asked all my questions before. So I really learned a lot from this discussion. Thank you so much.
Thank you, Xiaoyan.
Well, thank you.
And also, Hengjie thank you for your very devoted and insightful discussion.
Thank you.
Yes.
Yeah, I also would like to thank heartfeltly to Hengjie. So first, he started from the micro foundation of limited commitment and go from expert serious perspective to help to illustrate the model intuition in crystal clear manner. And then he also provide many potential future directions by utilizing the quantitative dynamic models, which right now is undergoing. And I think they are very, very insightful and helpful for me.
We're grateful to all of you. Hengjie, do you have any concluding words before we close?
No, except I really like your point of liquidity. I think I felt like presumably the POE's productivity may be more volatile than SOE's. So in case the POE didn't really work out and leasing contract has some flexibility, SOE can go to some other firms, and I thought that's a good perspective.
Any last words from Kai?
Oh, Bernie, actually, if you allow them, let me have 1 more minute to talk about the regulation. So
Yes.
basically, one very important implication of this paper is that the finance lease actually is a more collateralizable way of the shadow banking activity. It is a productive way of the shadow banking activity. Therefore, if we consider the important capital reallocation efficiency role of the finance lease, actually, it says that, it suggests to the regulatory authority that maybe we should treat different component of the shadow banking differently when they are setting up their regulation exercises.
Right. And in particular, the very high very high loan to collateral ratio is for good reason here. Well, thank you very much to all. I really enjoyed the presentation and the discussions, and thanks to the audience for attending. On October the 16th, let me just make sure to double check because we're always the third Thursday. The paper is going to be on digital nudging and transmission of financial educations and information that motivate more participation in stock market. And sorry, no cronyism, but I'm going to be the one who present the paper. And Professor Alberto Rossi from Georgetown is going to be the discussion. Thank you very much to you all for helping us. Thank you.
Thank you, everyone. Look forward to Bernie's next presentation.
Thank you.